Have you ever wondered whether you should pick individual stocks or simply invest in ETFs? Both can grow your money, but they work very differently. Picking stocks feels exciting because one big winner can create huge gains. It feels like finding the right company could change everything. But when the stock starts falling, the decision becomes stressful. Should you sell, hold, or buy more? In this video, we will compare the excitement of stock picking with the simplicity of ETFs. We will look at the benefits, the risks, the common mistakes, and what may make sense for most investors. Let's start learning about stock picking versus ETFs. Before we begin, please note that this video is for learning purposes. It is not financial advice. Investing has many downside risks. Please perform additional research before investing. Now, let's take a look at why stock picking feels so attractive in the first place. Some companies have created massive wealth for long-term investors. These famous winners make stock picking look very powerful. Let's take a look at the NVIDIA stock chart on the TradingView website from 2016 to 2026. The stock has shown strong exponential growth. In the 10 years shown in the chart, the stock has gone up by a huge 34,089.05%. A $100,000 investment in the year 2016 would be worth $34,189,050 in June 2026. New companies and IPOs can also create a lot of excitement. Investors often think they are finding the next giant winner company. When the chart is rising and everyone is talking about the stock, it can feel like the opportunity is obvious, but obvious-looking opportunities can still be risky. Some investors think that they can find the next big, amazing company, hold it for years, and watch the money grow. Stock picking attracts investors because the upside is easy to imagine, and the winning stories are everywhere. But let's also take a look at the information that many investors don't know about the approach of investing in winning stocks. We usually hear about the winners after they already became famous, but many disappointing stocks receive much less attention. Some companies once looked extremely promising, but later fell sharply from their peaks. Popularity does not always mean a good investment. Let's take a look at the Rivian stock chart on the TradingView website from 2022 to 2026. The stock has shown a significant reduction in price. In the duration shown in the chart, the stock has gone down by 84.52%. A $100,000 investment in the year 2022 would be worth only $15,480 in June 2026. A company can have a useful product and still be a bad stock if the price was too high. In investing, what you pay matters. Now let's take a look at the difficulties in predicting winners when investors are trying to decide where to invest their money. The difficult part is predicting the winner before the market already knows it. Business performance, competition, interest rates, valuation, and timing can all change the outcome. Even many professional fund managers struggle to beat broad market indexes over long periods. That shows how difficult stock picking can be. It is also important to understand the huge downside risks involved in any investing activities. When too much money depends on one company, one bad event can hurt the entire portfolio, and the stock price may not increase to the earlier peak levels. If a stock falls heavily, there is no guarantee it will recover. Some stocks bounce back, but others stay low for years. Now, let's take a look at the time, effort, and emotions involved in stock picking. Picking stocks can take a lot of time. You may need to follow earnings, news, charts, competitors, and market conditions. Most individual investors already have jobs and responsibilities. Turning investing into another full-time job may create stress instead of progress. Stock picking can also make emotions stronger. Fear can push you to sell too early, and greed, or the fear of missing out on the hype, can push you to buy when the stock has become too expensive already. Stock picking is not only about analysis, it is also about time, patience, and emotional control. Now, let's take a look at ETFs and why many investors use them as a simpler alternative. An ETF is a fund that trades like a stock. Many ETFs hold a basket of investments, so one purchase can give exposure to many companies. A common example is an ETF that tracks the S&P 500. Instead of betting on one company, you're investing across many large U.S. companies. Let's take a look at the Vanguard S&P 500 ETF chart on the TradingView website from 2016 to 2026. The ETF has shown steady growth. In the 10 years shown in the chart, the ETF has gone up by 256.53%. A $100,000 investment in the year 2016 would be worth $356,530 in June 2026. Let's take a look at the benefits of investing in ETFs as compared to investing in stocks. Inside an index, some companies may do poorly, while others do very well. The stronger companies can help balance the weaker ones over time. ETFs do not remove risk, but they can reduce single company risk. Your outcome is not based on only one company succeeding. ETFs are not risk-free. A broad market ETF can still fall during recessions, bear markets, or periods of fear. Let's take a look at the Global X FinTech ETF chart on the TradingView website from 2017 to 2026. The ETF showed a continued uptrend from 2017 to 2021. In 2022, there was a major decline. In 2024, the ETF showed a relatively smaller uptrend. However, in 2026, it started declining again. The ETF has failed to reach the earlier peak levels that were set in the year 2021. Now let's take a look at the common investing mistakes made by many investors. Before choosing a strategy, it's important to understand the mistakes that can hurt investors in both approaches. One common mistake is buying only because a stock or ETF is trending due to a lot of hype. By the time everyone is excited, the price may already be too high. Another mistake is trying to time the market with random stock picks and getting into a lot of confusion caused due to not having a clear plan. Some investors put too much money into one idea. Even a strong investment can become dangerous if the position is too large. Constantly changing strategies can also hurt results. Long-term investing usually requires patience through boring and difficult periods. Now let's take a look at the real question investors should consider while investing. The real question is not only which strategy can make the most money. The better question is which strategy you can realistically follow for many years. Some investors may use ETFs as the core of their portfolio and individual stocks as a smaller optional part. This keeps things simpler while still allowing room to learn. The goal is not to look smart for 1 month. The goal is to build a strategy you can follow through good markets, bad markets, and boring markets. Thank you for watching this video. Please like the video and subscribe for more videos related to investing and finance. Please comment below to tell me about your experience with stock picking or ETF investing. And also comment about what topic you would like me to talk about in the next video. Thanks again. I will see you in the next one.